Here are my top 9 stocks to buy right now, half of which I already own and half of which I've never talked about before on this channel. We'll alternate one stock that I own followed by one stock I'm still considering until we work our way up to my largest overall investment, which is completely different from last month. And at the very end, I'll show a pie chart of my entire stock portfolio, including stocks that I don't have time to talk about today. Hopefully you'll find a new stock to kick off your research before investing. So let's start out by showing my actual stock portfolio performance throughout the past year. So that you know I'm not just making stuff up, here's my actual Charles Schwab portfolio. We can see that it's up around 35% over the past 6 months, but it hasn't been a smooth start. It's had rises and then drops and then rises again, which tends to happen when you invest in technology and high growth stocks, both of which are core to my portfolio. And at the end of the video, I'll show you all the stocks that make up this portfolio. So the first stock we're going to talk about today is Crowdstrike, which I currently own 55 shares of at a value of $8,299, and that's up around $2,000 from my initial investment. Now this actually slightly underestimates my investment in Crowdstrike because I used to own it a few years ago, made around a 300% return, and then sold out of it before buying back in more recently. Crowdstrike is a cloud-native security company. Unlike a lot of traditional security companies, Crowdstrike is cloud-native, meaning it's better at protecting cloud workloads because they've always run on the cloud. This gives them a competitive advantage as more and more companies are moving to the cloud, as Crowdstrike is by far the leader in this category. We can see in Gartner's rating of security companies' ability to execute and completeness of vision, Crowdstrike ranks right at the top right next to Microsoft. And we can see this clear ability to execute in the actual earnings numbers behind the stock. The stock price is up over 41% over the past 6 months, and if we look at their revenue, it has increased nearly 42% in the last year, up to a revenue run rate of around $2.5 billion per year. But that's not just a one-off. If we look at their previous quarter, they were growing at 48%, before that 53%, and before that 58%. Now at a certain point, Crowdstrike's growth rate is going to slow down as the law of large numbers just makes a larger and larger base that they have to grow off of every subsequent year. But the fact that they're still growing at such a high rate while making so much revenue is really exceptional. Now historically, Crowdstrike has focused a lot more on growth than profitability. If we look at their net income from a year ago, it was negative $50 million, and it's been negative in all subsequent quarters until their most recent one, when they made a very slight profit. But more importantly for this company, even though they're not profitable, they are producing net cash flow, which means they have a lot of optionality when it comes to their cash position, which just puts them in a good position strategically as we continue to see the broader trends of cloud and cybersecurity continue to grow. And the fact that Crowdstrike has been at the lead of using AI in cybersecurity for years at this point puts them in a really good spot as we see AI begin to explode even more than it has before. But now let's move on to a stock that I don't currently invest in, a game-changing technology stock which I actually argued against investing in a few years ago, which was the right call at the time, but that may be changing today. Palantir is a data company. Their stock price is up well over 150% for the year, with most of that rise in just the last 3 months. But while it's easy to say what this company does, they allow companies and governments to use their data more effectively. Describing how they do that is a little bit more difficult because this company is extremely secretive, which makes sense considering they have contracts with both the US Department of Defense, military, and the NSA. But even with that secrecy, we can still determine if this is a good investment. Palantir offers 3 main products: Foundry for creating a central operating system for an organization's data, Gotham for identifying patterns in data, and Apollo for pushing updates, managing the cloud infrastructure, and making sure Palantir systems can run in almost any environment, which is pretty important considering they often perform analytics work in the field for the military. But while those products are interesting, what's more important for investors are the actual numbers behind the company. And the company has recently become net income positive after spending years investing their profits back into the business, and analysts expect that trend to continue. Right now, we're in a market that's kind of transitioning from awarding growth at all costs to focusing more on income as we start to face some economic headwinds. And Palantir's switch from a growth-oriented company to a company that produces income couldn't be better timed. And they still have a lot of runway to go. With their platform that provides a competitive advantage to every company or government that uses it, their clear vision for the future, and the fact that they are riding the dual trends of data and AI puts Palantir in a very strong position going forward. I don't currently own any shares in Palantir, but make sure you watch until the end when you can see my largest single investment that I hold in my portfolio. And if you appreciate the transparency, maybe consider subscribing. We're trying to get to our goal of 50,000 subscribers by the end of the year, and if everybody watching subscribed right now, we would hit that goal today. But as important as it is to diversify between different types of stock to lower risk, stocks are not the only way to diversify your portfolio while earning passive income, which is where this video's sponsor, FranShares, comes in. FranShares works to give everyone the opportunity to earn fully passive income, not by investing in stocks, but by investing in franchises. This unique opportunity allows investors to diversify away from just stock investments while earning income passively. Historically, wealthy individuals and private equity groups have invested in franchises to diversify and build wealth. Running a franchise has always required time, a bunch of upfront money, and expertise in how to manage it. So it hasn't been a passive investment available to your average investor. But not anymore. FranShares allows anyone to invest in franchising, offering several benefits to investors. It's fully passive without any of the management paperwork or other red tape that comes with owning a franchise, while still having the ability to receive regular distributions. That's just cash in your pocket. It offers true diversification through tangible assets that spread across different industries, locations, and service offerings. And it offers the ability to not only receive passive income, but to see your equity appreciate in value if the value of your franchise locations increase in value. And FranShares focuses on investing in recession-resistant industries. When the stock market falls, people will still likely get haircuts, go to the gym, take out their trash, and order from restaurants, meaning this potentially offers a safe haven from the emotional swings of the stock market. Plus, if you go to their website, you can see a franchise investor guide to get you started and learn more about franchise investing. So click the link at the top of the description to check out FranShares, and now let's move on to a stock that's not just selling software, they're selling the hardware that is going to run the future of energy. Enphase is an energy management company. I currently own 77 shares in this stock worth around $13,500, and it's up around $1,000 from my initial investment. Enphase is essentially a next generation energy company focusing on all things around renewable energy and especially solar power. The company's been taking advantage of the trend toward renewable energy and the US's support of that trend, and they've been investing heavily into battery technology, including batteries that can support grid technology that would be used for storing solar power. The thing about solar power is actually producing solar power isn't really the most difficult part. Yes, you need solar panels to actually capture the sun's energy, but the more important part is what do you do when the sun's not shining? Well, for that, you need really reliable batteries, and you need them to be cheap enough that it's still economical to use them. Enphase makes a lot of the technology that can power these battery systems. They make the batteries themselves, they make microinverters. They have a system that lets you have bidirectional EV charging from your home to your car or from your car back to your home, allowing any EV, not just a Tesla, to act like a battery for your house. As much as I like Tesla as a company and I appreciate how much they're pushing electrification of the grid forward, Tesla is not going to be the only winner in this market. You're going to have other companies that try to compete in EV and solar panels and battery technology, but the thing they all have in common is they're going to need technology to connect each of those individual systems. Enphase plays in a really interesting area because they don't directly compete with any of those other companies. They just tie them all together. This is part of the reason that this stock is up over 3,000% over the past 5 years to a current market cap of just under $25 billion. But honestly, the craziest thing about Enphase is their ridiculous revenue growth rate. If we look at their revenue growth rate from a year ago, they were making around $500 million per quarter at a growth rate of 67% year over year. The next quarter, they grew 80% year over year, then 75% year over year. And in their most recent quarter, they produced revenue of $726 million while growing nearly 65% year over year. That's even faster than Crowdstrike, and this is a company that produces physical goods. On top of that, this isn't just a growth at all costs company. They're actually producing net income of $146 million in their most recent quarter. Now, can this company sustain this growth for the long term is really the question that's going to determine how much the stock price could rise from here. But they are going to be releasing their next earnings call on July 27th, which is unfortunately after I'm recording this video, but that can give us a peek into what this company's future is going to look like. And as we get farther into my list of stocks, we're going to get to higher and higher conviction positions that I'm investing in. But next up, we're going to go to a stock that probably everybody has heard of, which I don't currently invest in, but I am looking into. And that company is PayPal. PayPal is an interesting company in that they had a massive rise in their stock price throughout 2021 before hitting a peak around 2 years ago and then massively dropping off in price since then. In fact, if we look at their stock performance over the past year, they're down 10%. If we look at it year to date, they're down 2%. If we look at it over the past 6 months, they're still down 8%. And the company has really floundered and struggled to achieve the same success that they saw at the height of lockdowns in 2020 and 2021. But when we dig a little bit deeper, there may be some gold hidden in this rough of a company. PayPal has beaten consensus analyst estimates for their earnings consistently for the past year. And even though they might not be showing the same numbers that they had at the height of lockdowns, they are showing revenue growth of 8.5% year over year in their most recent quarter. And this is a company that's producing $7 billion in revenue every single quarter and nearly $1 billion in net income every 3 months. So this would be a slightly different kind of investment. We're not betting here that PayPal is going to grow 50% next year. What we are betting is that they are a much better option than cash and that they're producing consistent net income. They offer a service that is obviously going to continue to grow as the size of the internet in general grows, and they're a technology-first company that is starting to incorporate AI into their products. PayPal CEO Dan Schulman recently said that AI made one of his teams 30% more productive. And similar to a lot of companies that are dealing with the flow of money online, there are several opportunities for PayPal to apply AI to their actual products, including fraud prevention, basically analyzing a bunch of different transactions and proactively determining if fraud is going to occur using an AI model, and be able to improve their authorization rate using machine learning models to predict and address whether or not something is going to get declined when the user makes a payment request. In an already mature company where you would normally expect only incremental improvements over time, these offer the potential to dramatically drop PayPal's costs and increase their margin, which just produces more net income, which should drive their stock price higher. But next up, we have another stock that I own, which is riding one of the largest investing trends of the next decade. Zscaler is another security company, but they operate in a very different area from Crowdstrike. Zscaler focuses on the zero trust space, basically authentication between different applications. You can think of a traditional security model like a firewall. It's like building a moat around your castle. It keeps the bad guys out, but if they manage to cross the moat, they basically have free access to everything. Zero trust security means that every computer, every application, every person on the network has to re-authenticate anytime they're talking to someone else. So even if a bad guy gets into your network, they can't actually do anything because they can't authenticate. And what's most important about that is it's the way that most cloud applications like to use security. Cloud applications are generally hosted on someone else's computers and infrastructure, which means building a firewall around the entire thing isn't that practical. So as we see more companies moving to the cloud or companies with existing cloud workloads continuing to grow, that benefits Zscaler. Now, I currently own 82 shares of Zscaler at a value of just over $12,000, and this one's actually down pretty substantially, down $7,000 overall. And we can see why when we zoom out a little bit. Zscaler hit their peak back in November 2021, which was basically the peak of the tech market, and then they had a massive sell-off through around April of 2023. But if we change up this view to instead look at the year to date, the company has recovered pretty substantially from the start of the year. They're up 35% since January, which makes sense. During the height of lockdowns, you had people working remotely, you had people logging on to their workplaces through the cloud, and there was a lot of need for a company like Zscaler. Now, while that need stepped back slightly as the lockdowns eased, the long-term direction of the entire economy is going to be toward cloud working because it's just way more efficient than a centralized mainframe. And this isn't me just talking, we can see this showing up in Zscaler's earnings. A year ago, they made $300 million in revenue, growing at 61% year over year. In their most recent quarter, they made $418 million in revenue, growing at 46% year over year. So that's a nearly $2 billion revenue run rate while growing at 46% year over year. And on top of that, while the company is not yet profitable in a GAAP accounting sense, they are producing net cash flow, which in my opinion is more important during an economic recession. And here's why. Profit is kind of a hard thing to measure. It's really an accounting standard. Net cash flow is literally how much cash you are bringing into the business every single quarter. As long as you have net cash flow, your business isn't going to go under. But it is possible to be profitable and still run out of money to run your business and actually lose your company. In a recession, cash is king. It gives you the ability to buy back your stock price if it drops too much, to purchase competitors, or to invest more into your core business. And Zscaler is now in a position where they have incredible growth and they have cash on hand that they can use to survive any economic headwinds that come their way, which is why this is one of my mid-sized positions. But now let's pivot away from the security companies and to another stock which I don't currently own called MongoDB, which is a database company. If you talk to any cloud developer in the world, they've probably heard of MongoDB. And the reason for that is MongoDB makes it really easy to build next generation applications that require data. One of their taglines is it's built by developers for developers, and this is really clear in their tooling. It's a really easy tool to use, and a lot of developers prefer to use MongoDB over a lot of other options that are out there. But there are also specific advantages to Mongo's setup that can't be replicated elsewhere. MongoDB creates what's known as a NoSQL database, which is very different from traditional SQL databases. You can think of a traditional database almost like an Excel spreadsheet. You have your rows, you have your columns, and then you fill in all the data according to those. This is great if you have a lot of data that's very well organized and you always know what the name of the row and the column is going to be. But where you run into issues here is where you're running into data that doesn't follow that pattern. Imagine you want to keep track of a bunch of users and you only have the address for half those users. Well, in a traditional database, you still have to keep track of all those addresses, but they're just blank. In a NoSQL database, you don't have to store any information that isn't present. There's no blank entries that are just wasting space, and it's so flexible that you can change the schema of the database on the fly. Have you ever had to completely reorganize an Excel spreadsheet when you get a new piece of data that doesn't really fit in with how you have it currently arranged? Well, it's a pretty common problem, but with NoSQL databases, that same problem doesn't really arise. And more importantly, this type of database tends to be used more by startups and companies trying to build light cloud applications that need to be flexible, which means that MongoDB benefits as more applications are deployed onto the cloud and as the next generation of developers begins to take more and more control over architecting applications. And they're allowed to choose the tools that they prefer to work with rather than being stuck with traditional database tools and methods from the past. And we can see the success of MongoDB in their stock price. Over the past 5 years, the stock has increased 588%. And while, like a lot of tech companies, they did have a crash from November 2021 through the start of 2023, they've had a miraculous recovery year to date, up 114% for the year. In their most recent quarter, MongoDB produced $360 million in revenue, growing 30% year over year. But more importantly, they are a cash cow, producing massive free cash flow every quarter, which, like I talked about earlier, puts them in a very strong position if we head into an economic recession. So you have a strong brand among developers, really strong technology, and strong earnings fundamentals. Nothing not to like with this company. The next company we're going to talk about is a little bit different from some other ones, and it's another stock that I own, Bill.com. Bill.com I currently own 54 shares of at a value of just under $7,000, and it's down around $2,000 off of my initial investment. And I bet you can guess when I first invested in this stock. If we look at them over the past 5 years, while the stock price is up, they took a massive drop from November 2021 through the start of 2023, and then they've been recovering ever since then. This is an incredibly volatile stock. If we look at the drop from their peak to the bottom, they dropped by 79%, and then from the bottom up until now, they rose an additional 70%. So depending on the exact month when you invested in this stock, you could have made a ton of money or you could have lost money like I did. But here's why I do believe in Bill.com for the long term. Bill.com is in the business of automating back office operations for small and medium-sized businesses. If that just sounds like a bunch of buzzwords, here's what that actually means. Most small businesses run their accounting, their billing, all of the stuff that has to go on behind the scenes to run their actual business on physical pieces of paper or a lot of times in Google Sheets or Excel docs. Bill.com takes that whole mess of kind of ad hoc stuff that businesses are doing and unites it into a single platform that can be automated for the business owners. This is incredibly sticky because once the business gets onboarded, it would take a lot of effort for them to move somewhere else, and Bill.com pretty much always saves the companies more money than it costs them to use the platform. Now, up until around a year ago, Bill.com was basically operating in a greenfield opportunity. No one else was doing what they're doing. Recently, more competition has entered the field, but Bill.com is still ahead of the competition. The company is growing at a very high 63% year over year in terms of their revenue, while passing a $1 billion per year revenue run rate. And one of the advantages to Bill.com that a lot of people don't talk about is all the data they get access to. Whenever a company is sending an invoice to another customer or storing a supplier's data, most of the companies that other small businesses interact with are themselves small businesses, meaning they are potential Bill.com customers. Bill.com is able to store all of this data for all of these customers and basically create a network of every small business in the entire country, giving them a massive distribution base that they can then sell into. Plus, Bill.com is able to scale as the business grows. So if you have 5 small businesses and 3 of them grow to become medium-sized businesses, they all make Bill.com more money as they grow. Now, a few warnings with Bill.com. First of all, they are not currently profitable, and second of all, they don't have the same kind of free cash flow positive business that a lot of other companies on this list do. This means if we hit a major economic recession, small businesses could be hit hard forward, which could hurt Bill.com's earnings, and the fact that the company doesn't have free cash flow means they may struggle more in a recession than some of the other stocks on this list. I do think Bill.com has enough going for it that I personally am willing to invest in it, but those are some areas of caution if you're just getting into the stock. But now we have the last company, which I don't currently own, followed by the single largest investment in my entire stock portfolio. The next company is Monday.com, which in a way is kind of like a much more mature version of Bill.com. Monday boasts customers like Coca-Cola, Universal Music Group, and Hulu, and they bill themselves as the operating system for your workplace. The company only went public relatively recently, back in June of 2021, and obviously they suffered from the same sell-off from November 2021 through the start of the year. But since the start of the year, this company is up 45% year to date, producing revenue of $160 million at a 50% growth rate year over year. Now you might say, wait a second, doesn't that make Monday.com smaller than Bill.com? Yes, they just address a different part of the market. Bill.com is really focused on small to medium-sized businesses and operationalizing their backends. Monday.com is basically trying to become the next Salesforce. And kind of in the same way that Salesforce started out in a very specific niche before growing to completely dominate the CRM marketplace, Monday.com is kind of doing the same thing. I would say a direct competitor for them right now is Atlassian, which produces Jira and several other tools that are used in workforce management. They offer tools like keeping track of which tasks are being done, doing monthly planning, building campaign dashboards that can be used to run your business. In their most recent earnings call, the company also talked a lot about AI and the new tools they're developing that use AI, but it's still pretty early days on that, and I probably wouldn't give them too much credit for that until we actually see that show up in the business. More interesting to me is the fact that this company's earnings numbers are improving very quickly. If we look at their net change in cash on hand from a year ago, it was negative, then it became slightly more positive, then slightly more positive, and in their most recent quarter, they made around $50 million in cash, and they've also turned adjusted operating income positive, meaning if you cut out all of their fixed costs, the company is now producing a profit. So if they continue to scale from here, it should only increase the profitability of the company. Personally, I'm waiting to invest in this stock until we see a few more quarters of growth and maybe see some of those AI tools come out, but this is a good stock to keep on your radar. And last up, we have my single largest investment today, which also is the largest investment that I've ever had in my portfolio. And that company is Datadog, which you can probably guess from the name is a data company. I currently own 286 shares in Datadog at a market value of just under $31,500, and it's gained just under $5,000 overall. Now this is another company that I've owned for a while, and I've ridden it way up, way down, and then back up again. From September 2019 through November 2021, the stock price rose 432% before dropping dramatically through the start of 2023 to negative 66%, and then rising again another 71% from there. So depending on when you bought this stock, you could have made a massive profit or lost money. Now Datadog is a data company. They unite a company's applications, their security, and their infrastructure through what they call a single pane of glass. Basically a single dashboard where you can look at your company's metrics and make decisions based on that data. Clive Humby, a British mathematician, said that data is the new oil, but just like oil, it's not valuable sitting in the ground. You have to extract it, refine it, and then use it for something before it creates you money. When companies use Datadog, they're able to start producing value from their data. And as companies produce more data from moving to the cloud, from IoT devices, from generative AI generating data out of nothing, services like this are not just going to become helpful, they're going to become essential to understand what's happening in your business. Gone are the days where gathering data was the hard part. Nowadays, the hard part is extracting insights from that data and filtering out all the noise. And you know how we can tell that Datadog is pretty good at doing this? Well, they produced $480 million in revenue in their most recent quarter while growing at nearly 33% year over year. And if we look at the company's price to sales ratio, which basically represents the value of the company divided by the total revenue they're producing, it's currently sitting close to the cheapest it's ever been at a price to sales ratio of 19.7, up from 13 in March of 2023. So if the company's price to sales ratio were to rise back to the very high 54 number it saw back in December 2021, that would almost triple the stock price from here. Or if the company kept the same price to sales ratio, but the revenue just grew at 30% year over year, well, that would cause their stock price to rise 30% each year. Now, I'm not saying for sure that either of those situations will happen, but it just goes to show how important growth can be to a company's stock price rising. And I promised at the end of the video I would show you my entire stock portfolio, so here it is. Make sure to like and subscribe to help us get to our goal of 50,000 subscribers by the end of the year. You just watched a 20-minute video covering 9 different stocks to potentially invest in, so if you got value from from any of them, please just consider subscribing. I'll see you next time.